All right, welcome to the Explainer. Today we're diving deep into two of the most important tax benefits out there for higher education, the American Opportunity Credit and the Lifetime Learning Credit. We're going to go straight to the source, the Internal Revenue Code, to see how these credits really work, getting into the nitty-gritty beyond the usual summaries. So here's the plan. We're going to start with the law itself to build a solid foundation. Then we'll walk through the two main eligibility hurdles you have to clear, that's income and expenses. After that, we'll put the credits side by side to really compare them, and we'll wrap up by looking at a major change that's taking effect for the 2025 tax year. Okay, first things first, where do these tax credits even come from? See, to really get a handle on how they work, you have to start with the law itself. Understanding this legal foundation isn't just background info, it's the key to applying all the rules correctly. So the single source of truth for both the American Opportunity Tax Credit and the Lifetime Learning Credit, well, it all lives in one place, Section 25A of the Internal Revenue Code. That's it. This is the governing statute for the whole shebang. And this one section is basically the blueprint for everything. It's what allows you to take a credit against your tax, and then it lays out all the specific rules, the mechanics, the dollar amounts, the limitations for both the AOTC and the LLC. Seriously, every rule we're about to talk about flows right from here. All right, so we know where the rules live. Now let's talk about the first major hurdle you have to clear to even think about claiming them, the income test. And this is a big one. It's a critical gatekeeper because, look, if a taxpayer's income is too high, nothing else we talk about is going to matter. The specific term the IRS uses here is Modified Adjusted Gross Income, or MAGI for short. And the Code of Federal Regulations, specifically Section 1.25A1, defines it super clearly. For most of us, your MAGI is just your adjusted gross income, your AGI. But there's a small tweak. You have to add back in any income you earned abroad or from certain U.S. possessions that you might have excluded from your gross income. So for the 2025 tax year, the income limits are actually the same for both credits. Let's break it down. If you're a single filer, the credit starts to phase out once your MAGI hits $80,000, and it's completely gone by the time you reach $90,000. For anyone married filing jointly, you just double those numbers. The phase-out kicks in at $160,000, and the credit disappears entirely at $180,000. Okay, but what happens if you land inside that range? You're not below it, you're not above it, you're right in the middle. Let's say you're a single filer with an $85,000 MAGI. The good news is the credit isn't just an all-or-nothing deal. Instead, it gets reduced proportionally, or ratably, as the IRS likes to say. So how exactly do they calculate that reduction? Well, the law itself, right there in Section 25AD, gives us the exact formula. It's actually a pretty simple ratio. You just take the amount your MAGI is over that starting threshold, and you divide it by the total size of that phase-out window, which, as we saw, is $10,000 for single filers or $20,000 for joint filers. Let's make this real with our example. We've got our single filer with an $85,000 MAGI. They are $5,000 into that $10,000 phase-out range, right? So $5,000 divided by $10,000, that's a fraction of 1/2, or 50%. This means their maximum possible AOTC, which is $2,500, gets cut by 50%. So you subtract $1,250, and they're left with an allowable credit of $1,250. Simple as that. Okay, so let's say a taxpayer makes it past the income test. What's next? The next crucial step is figuring out which expenses actually count for the credit. And believe me, the definition here is very, very specific. Generally, what we call qualified education expenses, or QEE, is pretty straightforward. We're talking about tuition and fees that are required for you to enroll or attend an eligible school. A college, university, or vocational school. And this can even cover things like student activity fees, but only if they're mandatory for every single student. Now listen up, because here's a critical difference that trips a lot of people up, and it comes straight from IRC Section 25A F1D. It's all about how you treat course materials. For the AOTC, the rule is pretty generous. It includes books and supplies, and it really doesn't matter where you buy them, the campus bookstore, Amazon, wherever. But for the LOTC, the rule is way, way stricter. Those exact same books and supplies only count if the school requires you to pay the institution directly for them. Huge difference. Okay, so beyond income and expenses, these two credits have some really important operational differences. And knowing these is absolutely essential for making the right call on a tax return. Because, and this is key, you can only claim one of these credits per student per year. You have to choose. This chart really lays out the big differences side by side. First, notice the AOTC is calculated per student, while the LLC is per tax return. And that's a big deal for families with multiple kids in college. The AOTC is also partially refundable, meaning you can get cash back even if you don't owe any tax. The LLC, totally non-refundable. But here's a massive difference. The AOTC is capped at 4 years of undergrad study. The LLC, on the other hand, is unlimited. You can use it for graduate school, courses to improve job skills, anything. That job skills rule is one of the coolest things about the LLC. It really broadened its use way beyond just getting a degree. But what does that phrase, to acquire or improve job skills, actually mean when you get down to it? Well, the Code of Federal Regulations actually gives us 2 perfect examples to spell this out. Let's say a professional photographer takes an advanced photography course. That qualifies because it's directly improving her job skills. But now, take a stockbroker who takes a photography class just to get ready for a vacation safari. That does not qualify because it's just for a hobby, you see? The intent behind the education is everything. All right, last section. Let's look ahead to 2025. There's been some recent legislation that consolidated a bunch of education benefits, and because of that, there is a major change coming to the lifetime learning credit, and it's going to completely alter the strategic calculation between these 2 options. So this new legislation has a direct impact on the lifetime learning credit, and it's making it a much more powerful option for certain people than it's ever been before. So what's the big change? Starting with the 2025 tax year, the maximum lifetime learning credit is jumping up by 50%. It's going from $2,000 all the way up to $3,000 per return. So let's do the math on this. The LLC is a 20% credit, right? So to get that new, full $3,000 benefit, you now need to spend $15,000 on qualified expenses. And this is a total game changer. It means for anyone with really high tuition costs, think graduate students, professional degree programs, the LLC is now mathematically a better deal than the $2,500 AOTC. So when you put this big LLC expansion together with all the technical rules we've just walked through, it is crystal clear that the whole strategic landscape is shifting for 2025. You really have to master these details to make sure you're getting the absolute maximum tax benefit for every dollar spent on tuition. Which really leaves us with one big question. Is the newly beefed up lifetime learning credit the new king of education tax benefits? You know, for a lot of people in those high-cost programs, the answer is starting to look like a resounding yes.